This lesson is part of the price action series and it's on trend lines. Extremely commonly used and very often misused price analysis technique by traders. So let's look at trend lines. Let's look at what do they represent and how should we actually trade them. First, I think you know what I'm going to say. A trend line, like any pattern or any TA tool, is not magic. Okay? There is no scientific reason for trend lines to work at all. And they do not represent support or resistance. That's very important because they're not horizontal. Support and resistance is represented by where orders are on the order books. Orders cannot be placed diagonally. They can only be placed horizontally. That's important to note because a lot of people buy or sell trend lines blindly without any context to them. They just buy when it hits or sell when it hits. That's the wrong way to do it. What are they good for? They are best used for seeing what other traders see, and when they're combined with market structure principles, they can give great confluence to both uptrends and downtrends. Important part there is that you want to use trend lines that other traders see. You'll notice a common theme throughout my lessons on price action that's quite counterintuitive to what most new traders think. You want to use timeframes, trend lines, patterns, all those things. You want to use those, the ones that multiple types of traders will see. You don't want to use something that nobody sees. If you find a trend line that's drawn all weird and nobody else sees it, it's going to have zero effect. Remember, they only have effect because people give them effect. For people to give them some type of effect, they have to be visible. So, I've summarized trend lines into 3 simple rules that can show you how best to trade them and some common mistakes to avoid. So let's go through those now. Rule number 1, if a trend line respects the price action, which preceded it, then you should look for entries on the same time frame or lower. So, what does that mean? If your trend line is holding in the direction you would expect it to hold for continuation, then you should look for entries in that direction on the same time frame or lower. So zooming in, we have 4 types of continuation trend line. We have a bullish rising trend line. Why is it bullish even though it's rising? It's bullish and rising because you have an impulse move up, which establishes the trend. You then have a trend line forming, which is supporting the impulse move. So you have an impulse up and a trend line up, which equals a high probability continuation on the breakout. The way you would trade that is a continuation trade. So if you're already long, you would remain long until something changes. If you are short, you would be wanting to exit before you get squeezed any further. And if you're looking to enter new positions, you can enter on a breakout or on a high probability setup along the line, depending on your other techniques. You can use volume, you can use other techniques to enter. The main thing is, impulse was upwards, trend line was upwards, high probability continuation if the trend line holds. Second one is a bearish falling trend line. So this is the inverse of what we just saw on the bullish side. You've got an impulse move down, which establishes the main trend. You then bounce into a corrective move, which is the opposite of an impulse. If you remember this from the market structure lessons, which you should, you'll know that trends move impulse, correction, impulse. So the impulse is a move down or up with very little move in the opposite direction. And then the correction is normally sideways or in the opposite direction, and it's quite a weak move. So the price action is not impulsing, it's just chopping. Your bearish downtrend line holds and gives a high probability continuation for the next leg down. Because the price action between leg 1 and 2, so you have leg 1 down, price action goes sideways, the trend line then supports continuation because it's in the same direction as the impulse. Trend down, trend line down, trend down. You're looking there at things in harmony. If you remember back, the concept I talked about in the Wyckoff lessons about harmony and divergence, that appears all over the charts, all over the market. Harmony is when things agree. So if you have an impulse trend and it's agreeing with the trend line and then it continues in that direction, you can expect it to continue until something comes along and changes it. Let's look at 2 more. And these are where the trend line breaks rather than being a continuation in the same direction. It's still a continuation trend line, but you'll see why in a second, that it's the other way it can go. So you have a bullish falling trend line. Trend lines can either rise or they can fall. The very nature of them is they are not horizontal, they are diagonal. So if it's going to fall down after an impulse move up, that's considered bullish and considered a continuation as long as you see impulse, correction, which we do here, then you have impulse again. Remember, impulse, correction, impulse, the trend line is corrective in nature, so when it breaks, it offers a high confidence continuation trade. This is one of my favorite trades, one of the best trades you can take when you learn how they work and how to play them correctly and most importantly when to avoid them. And you have a bearish rising trend line, another favorite of mine. First, again, as always, your impulse move establishes the main trend. So you should be noticing a theme here. it's not really a good idea to trade trend lines if there isn't a clear impulse before the trend line, because you must establish some high probability trend direction. So you have an impulse down, very few candles, strong move. You then have a corrective move up. It takes 3 or 4 times as many candles to form the correction as the impulse. That's a textbook correction. You impulse down fast, you correct slowly. Correcting upwards creates a bearish uptrend line, and the trend line is corrective in nature because impulse, correction, impulse. And when that trend line breaks, it offers a high confidence continuation trade. The reason it's a continuation trade is because we have a bearish rising trend line. So when the market is going down, you don't want to see a rising trend line, because a rising trend line, much like the bullish falling trend line, would signal that when it breaks, the market's going to continue in the direction that it was moving. So by knowing that, you can know to avoid longs, of course, and enter high probability shorts. So that's rule 1. If the trend line respects price action, look for continuation entries on the same time frame or lower. I'll touch on that for a moment. So let's imagine this is a 1 hour chart. You should only look for entries here on a 1 hour chart time frame or lower. Whatever time frame your trend line is marked on, that is your highest time frame for that trend. You cannot go to a higher time frame. You can't go to a 4 hour or a daily and start to execute. Same time frame or lower. Simple rule. Rule number 2, if a trend line breaks, you want to take note of it and become defensive. What does that mean? This is a very, very useful way of managing your trades live. So if you're in a trade, let's say you're in a short that's in profit, or you're in a long that's in profit, trend line breaks can give you great entries and exits. So defensively using trend lines. Let's look at a bearish trend flipping to bullish. You have your trend line. As long as price respects that trend line, then remember your rule from number 1. You go with the trend. The trend is down, the impulse moves are down, and the trend line is down. When that shifts and the trend line breaks, you abandon your bearish bias and you adopt a neutral view. If you've seen some of the other lessons, you'll understand that markets do not go from bearish straight to bullish. They go from bearish to neutral, ranging, then to bullish, or back into bearish. So you abandon your bearish bias. So if you were short, you should now be thinking about taking profit. If you are not in a trade, you should not be considering shorts. You should only be considering potentially longs, or again, doing nothing. You adopt a neutral view. You see then, the break is your first sign. Price then forms a range, and when it retests the range lows, if you are still in a short for some reason, this is your last chance to take profit. You need to take profit and get out. No matter how much it looks like this next one's going to break down, you have high probability that the trend has ended. You are not here to be a hero or to guess the market. You're here to play probabilities. The probabilities are telling you it's probably over. You should take profit. And of course here, once the original high gets broken and closed through, the trend reversal is confirmed, and more often than not, we see a nice move in the other direction. So the best method is to close partially immediately on the break of the trend line. Usually the trend line break will lead to a small range before a move in the other direction, but sometimes it can aggressively squeeze. So as soon as you get a confirmed trend line break, you should exit part of your short in this case. So if you're short from higher, you should take partial profits immediately once it breaks, once you get the first candle close, and then exit the rest at the lows if possible. Or if price seems like going higher, close it fully out. So that's the defensive way to use a bearish trend line breaking into bullish. Same thing, I'll just do it in inverse so you can see it as an uptrend. Same thing, you trend up, you break the trend line, so you abandon your bullish bias. So if you're long from lower, you abandon that bullish bias, you adopt a neutral view, you allow price to range, you get your last chance to take profit on your longs, you do not fight the trend, and when the reversal is confirmed, you can enter trades in the other direction, if you so wish. You should use the opportunity to take profits. Do not try to stick with the trend when it's showing weakness. Now, on rule number 2, don't exit your position immediately either. There are many instances where you have a trend line fake out and it continues higher, or trend line fake out and it continues lower. That is why once you get a close above the trend line, you take partial profit. That will help you as a trader. If you want to keep it simple, just take 50% profit, okay? Keep it very, very simple. That will help you manage your emotions as a trader, because not every time will it work out perfectly. Rule number 3, if a steep trend breaks, trade it back to the shallower trend. So let's explain this. You can also begin to exit a position in this rule we'll talk about in a second. All right, here we have a steep trend line. If you know what the word steep means, it means at a sharper angle. So the one that's going up faster is steeper, and then the shallower is the flatter trend line here. So generally, your shallower trend line will be drawn from further back and it will be confirmed with a couple of touches along the way. So you will have this one already. already marked. You will then notice that a steep trend forms on that time frame. So what do you want to do here? Well, when the steep trend breaks here, you want to trade it back to the shallower trend line. This is a very useful scalping technique. It's useful on all time frames. It's a good day trading technique. Let's imagine this was a daily chart. When you get a break, you go to your lower time frames and use your entry techniques because you have a clear target. Your target will be the shallower trend line. The steep trend line is often a trap because the simple rule for it is the market cannot rise like this indefinitely. It's too steep. It needs to pull back at some point. Whether that's bullish or bearish is none of your concern. Your concern is, can I catch the steep break and trade it to the shallower trend line? That's all you're looking for there. This can be on all time frames. That could be a weekly chart. And you could be trading it on a daily. The key with it is, as it starts to break on the steep trend, you want to go to a lower time frame. Remember rule number 1, you always trade it on that time frame or lower so you can get an entry and trade the impulse move. Let's do the same for a downtrend breaking. This is extremely common in crypto. Very, very, very common that we get very steep sell-offs because we get a lot of longs built up and we get liquidations. So we see a steep sell-off. We notice it breaks here. Price chops around and ranges for a little. When it starts to break upwards, you can trade it long into the shallow trend line, which you see started here, connected here, and that is your trade. You'll notice that rules 1, 2, and 3 intersect quite a bit, as they naturally would, because trend lines work across all time frames, and the principles of them are generally the same. But when your steep trend line breaks, a great target is a shallow trend line. You can wait for confirmation of the reversal with this breakout candle, and then trade it up to where you know your target is. So that's rule 3. If a steep trend breaks, trade it back to the shallower trend. Or begin to exit a position if it was in the direction of the previous trend. So what do I mean by that? Let's imagine you got long from here. If you were long from here or long from here, when this breaks and it holds the trend line, you want to exit your position because you have a broken trend line, a high probability reversal. Or even if you want to be extra cautious, on your lower time frame, as soon as this steep one is breaking, you want to exit because you know with high probability it's going to your shallower trend line. There's no guarantee that this will continue into an uptrend, as you can see here, of course, it reverses. And on this side as well, this one actually does turn into more of a ranging continuation move. But if you were short here and this steep trend breaks, you want to be exiting some of your short at this area because it's high probability going to squeeze up to the shallow trend line. And you don't want to get a nice entry up here and end up round tripping it all the way back. So those are the 3 core rules that I find for trading trend lines. And in the next 2 lessons, I'm going to talk about how you can use them high time frame, how you draw long-term trend lines as more of a confluence factor for the overall market and the psychology behind those, and also low time frame retail trap trend lines. So start to talk a little bit about what happens when trend lines break, how you can trade that, and how you can look at low time frame to catch out some inexperienced traders.